doing well today. It's been a minute since we've had a flash briefing, so today we're going to dive into a really relevant topic for what we are seeing going on in markets. And I am joined by two of our wealth advisors here at Creekman Wealth. I'm joined by Andrew and Connor. Some of you may have worked with them in the past. If you haven't, I would encourage you to absolutely reach out and set up a time to talk with either one of them about any questions that you may have. They are great resources and great members of our team here. So today, we're going to dive into talking about things that you can do to set yourself up for success whenever the markets get volatile. And, that's something that we are experiencing right now, and we really have for the first 4.5 months here of 2022. And there are a number of reasons for that, which we've covered ad nauseum in last week's deep dive with John and myself. And so we won't dive into them here. What we're going to talk about are the high level things or tools that you can be utilizing whenever the markets go crazy to ensure that over the long term, you're in the best position possible to succeed. And so when we talk about market volatility, what we're talking about is days where the market is up 1% at the open, it's down 1.5% because some data point came out, then it is even for a little bit, and then it ends the day down 1%. That is market volatility. And typically we see market volatility after periods of rising markets or great economic shocks. And that's what we're experiencing right now with a 40-year high in inflation and the Federal Reserve beginning to take steps to combat inflation. And so whenever there are periods of market volatility, a lot of times we see people really struggle to battle their emotions and to really separate fact from fiction. And sometimes people make decisions during these periods of extreme market volatility that hurt them in the long term as they pursue their financial goals. And so, Andrew, you recently wrote a great piece on this topic as it pertains to time in the market, not timing the market being important. Can you kind of walk us through your thoughts on that topic and how folks can best frame ways to set themselves for long-term financial success?
Yeah, so in the article, and I'll keep it pretty short, I think this is the most important data point that I wrote about in that article. So basically, there's a group called Winthrop. They did a study going back to the 1980s to, I think it was 2010, 2015. So it was a 30-year period of time invested in, I believe it was the S&P 500. So out of that 30 years, if you just stayed invested, stayed the course, your return was 12%. What I think is fascinating is if you missed the 20 best days in the market, your return went from 12% down to 8%. So that's not very good for just 20 days. And to put that in perspective, there's around 250 trading days in a year. Wow. Times 30 years. So that's 7,500 days. And all you have to do is miss 20 of them to lose 4%. And then it goes a little bit deeper and shows 40 days. If you miss the best 40 days in the market, your return gets cut in half from 12% to 6%. So think of that. I think that just speaks numbers. It only takes 40 days out of 7,500 to make the wrong decision. And it's emotional. I look at it and I'm like, oh, maybe I should get out. But, I read these studies and I see the numbers and you just can't time it, because when you get out, when are you going to get back in? Probably on the way back up. And that's the whole point of the study is you're going to miss those good days, and there's no way to tell when they are. And as we've probably seen the past couple weeks, yeah, some days are really bad. What were we down the other day, like 4 or 5%? Yep. But that could equally, sure, it would have been great to be out of the market that day, but there's no way anyone can do that and even do that consistently. So I think the whole point of it is time in the market versus timing the market, and we hear that all the time. It's just really kind of honing down and looking at the numbers and saying, there's no way I can, I can't time these 20 to 40 days out of 7,500. That's insane to think you're going to be able to do that.
Yeah, I mean, I think those numbers speak for themselves. That said, is there any group of people or individuals who maybe are just at a different stage of life where it'd be appropriate for them to have some or a large chunk of their investable assets not in the market when things get volatile?
Yeah, so that's another huge topic is, you, and I'm sure you have clients as well, like, hey, Drew, maybe we should sell out. And it's honestly, that's probably the worst decision you can make when it's down this far. But it all comes out to the pre-planning of, hey, if you're 65 years old and you're planning to retire this year, well, we probably shouldn't have been that heavy in the market
Yeah.
anyway. And that all comes down to planning, executing the plan, and keep following the plan. And the first couple of years of retirement when the market is down this much, that is hard. It's hard to stomach, but if you have a good plan set out and you're going to be fine by the
Yeah.
numbers, then and it just depends versus someone who's got 30 years left. Who cares the market? If the market goes down 50%, your life's not going to change tomorrow when you wake up. If you pretty much lose all the money, you still have another 30
Yeah.
years of work. So it doesn't really matter.
Yeah.
And I think it's just an emotional concept to see yourself go, cut down 20 or 30% money that you work hard for, but just know it won't be there forever.
Yeah. And one of the ways that we really here at Creek and Wealth, we've had folks retire in 2008. We've had people retire in March of 2020. But because we had that pre-planning that Andrew talked to, we were able to bucket out assets so that some had no risk, some had a little bit of risk, and some were fully in the market. And that allowed those individuals who are approaching a new life stage to stay invested with that growth bucket, to ride the wave, to have that time in the market that Andrew was talking about for those recoveries, to make sure they had those major up days, because they knew, hey, we got a couple of years of living expenses already over here on the side, taken care of, guaranteed. No matter what the market is going to do, we're going to be fine. And so Andrew nailed on the head that it's number one, it's time in the market, not timing the market that's important. And then number two, if you are approaching a new life stage, make sure you get with your advisor, do some pre-planning, get with Andrew, get with Connor, to really start getting a plan in place to bucket out those assets so you don't have to make one of those emotional decisions. Absolutely nailed on the head. And Andrew mentioned another thing. He talked about someone, hey, who's maybe 30 years away from retirement, and saying, hey, you can ride the wave of the market. And Connor, you wrote a post for more of that individual is 20 to 30 years away from retirement, talking about how the biggest and most important thing that you can do right now is save as much as you can and do it consistently. Can you kind of walk through that article and some of the data points you had there?
Yeah. So the founder of our office, John, has seen over the last 30 years that one of the most important things you can go after is having a high quality savings rate. The reason that's important is because it's the thing you can control. You can't control what the market does. You can't control exactly what rate of return you're going to get, but you can control how much you're saving. And so we've seen historically the people who are consistently putting money in the market, not taking the money out, not worrying about it the way Andrew was talking about, tend to have the largest nest egg put aside later on in life. So whenever we think about the greatest investor of our time, Warren Buffett, that's the person people often look to. A majority of his wealth, 97% in fact, came after he turned 65. This happened because he had a large base of savings set aside, so he was able to ride up that compound interest because he saved so much when he was young. So we've seen that having that high quality savings rate, creating that plan and sticking to it, regardless of the direction of the market, and sticking to that thing you can control is one of the largest contributors to having long-term success.
Yeah, yeah. And, I think what's interesting, I've had some people say, hey, do you guys do what you talk about? So let me flip this around. What do you guys do in your personal finances when it comes to saving consistently?
So me personally, I'm not going to speak for Andrew, but I actually use one of the models we have here at Creekmere Wealth Advisors that we suggest for people who are in my similar situation. I go into our equity ETF model, and so I'm saving 10% of my income into that, and I'm saving 10% of my income into my 401k, and then I'm saving another 15% for my liquid goals. And so my savings rate is 35% because I believe I need to have a high level of savings rate right now, because I currently don't need that money I'm saving, and I know later on I will. So I follow exactly what I'm preaching to people in that sense.
Nice, nice. Yeah, and so for me, it's a little different stage of life. So I'm using my 401k. I've never changed my 401k contribution. I've just increased it by 1% a year. And then I always try to max out my Roth IRA as quickly as I can. But I do save on every Friday. I save a certain amount of money no matter what the market's doing. It gets deposited into my brokerage account and it goes into an index fund. And that happens like clockwork. And so that's something that I personally have been doing to make sure I'm building that base that Connor was talking about.
So for me, I use a lot of the ETF models, asset allocation, diversification, all that. And I have, large, small, mid. And since I do have so much longer to work, I typically don't use bonds. I usually focus pretty heavily on small cap, the growth names. But with that, I see a lot of swings in my account that I don't necessarily like looking at every day, and I still do. But I just got to know. Got a long time to go. Yeah. So I think I do about 20%, or I try to max out the 401k and the Roth IRA, and then I have another taxable account that the stuff goes into.
Nice.
There's extra in there.
Nice.
So about the same kind of philosophy.
Nice. And you mentioned something. You try not to. You don't like looking at the swings in your account. Do you check every day, or do you maybe check most days, but when you have a day like the one you talked about earlier where the market was down 5%, you just don't even look? How do you guys approach looking at your own finances when it comes to these major swings and volatility in the market?
Well, so given our industry, I think it's a little bit different. For instance, as Connor knows, we're going through an office remodel right now. So Connor and we're not in the same office now, but we're technically sharing an office. So I have CNBC going 8 hours a day. So I probably check it more than I should. It's never not up on the screen, but that's the industry we work in. Yeah. I know, for instance, my friends who have accounts, my mother, they check it maybe, once a month, twice a month. But I do look at it frequently every day. And sometimes it drives me absolutely insane. And those are the times where I wish I was, over at Caterpillar with my mom and wasn't on a computer.
Yep.
For me personally, I check my true account values, my net worth. I check that once a quarter. So I only look at it that time, and I really check my overall net worth once a year. Beyond that, I go in there every week whenever my money is automatically deposited and make sure the trades happened. But I don't really look at the exact number of it. And then that quarter I'm checking, I readjust my allocation as I need to. But I tend to be hands-off in that approach.
Yeah, nice. It's always interesting to hear how everyone does it. It's good to hear that you guys are doing what we talk about with our clients. That's awesome. I would encourage each of you that are watching this video, if we said something that, just raised a question, or you just want to say, hey, how's my portfolio doing? Or do I have too much volatility for my stage of life? Or I'm approaching a decision point. I'm going to want to retire in the next 6 months, or we have a kid on the way and we want to set aside some more money. I would encourage you to reach out to us. We'll include a link where you can schedule a 15-minute strategy session with one of our advisors here in the office. We'd be more than willing to chat with you about that. And for those of you who have worked with us, you know that we are not salespeople. We're not pushy. We're not trying to get you to buy a product. At the end of the day, we want to help you define your why, define your goals, and then get a plan in place to go out and achieve that. And so we'd love to talk with you, and hope you found this information interesting. Thank you very much. Have a good one.